Hello and welcome back to Core Finance. I'm Matt Brown and I'm joined by Craig Erlam for the last of 3 videos today, and we're looking at the Kiwi dollar versus the US dollar. Been quite an active currency of late. Talk us through this chart. Seems quite a lot of fib levels on there. Where's it going from here potentially?
So I know it looks a bit messy, but there's a few things I wanted to highlight. So firstly, you've got this thick orange line which goes from the late June lows and also the early July lows. What this marks is effectively the potential neckline of a head and shoulders. That seems to be a key theme this morning on these videos. But you've got the first shoulder forming around here from early July. You've got the second shoulder peaking slightly above the first, granted, or maybe around the same level actually at the start of September. And then we broke, and the head obviously in the middle now. We broke below the neckline briefly. It is always a concern when you break below a neckline and you don't gather any momentum. So I wasn't overly convinced by this, the fact that we hit these 71s, you hit the 200, 233 day simple moving average and straight away we were back above the neckline. But that's where the test of the fib levels comes in, and I always find these useful because if we're going to go straight back above the neckline, then it's always the fib levels that are test, because as far as I'm concerned, until we break back above the head and shoulders remains in play. And we got towards that 61.8 fib, and granted this was Fed day, so we saw strong dollar, but then we've seen pretty strong dollar ever since. So it's always the chicken and the egg. Did Yellen all of a sudden make people far more hawkish the dollar in this case, or were people waiting for an opportunity to be long dollar? And Yellen provided that opportunity. It's always debatable, but we saw the rally up above the 74s on Fed day. Initial weakness in the dollar once the statement came out. Immediately reversed to the downside, and now we're trading back below the neckline. For me, this is playing out like a normal head and shoulders pattern. I think we want confirmation now, break below 71. That would make new lows. It'd take out the moving averages in the process. But that could then be a very bearish signal, because that would suggest we're heading back towards the kind of probably looking at maybe around 69.50s, 70s as a conservative projection based on the size of the shoulder to the neckline and below. But if we're looking at the head to the neckline, it's a far bolder move, and that would suggest we're heading back potentially towards these previous lows around 68. So some potential strong downside on the cards for New Zealand dollar.
Understood. Look out for that, and also look out. I think Royal Bank of New Zealand has a meeting today and rate decision. So any shocks could move it, send it either way. But in the meantime, Craig, thank you very much for joining us here today on Core Finance.
Thank you.